Good morning, everyone. My name is Dr. Harish Ahuja. I head the Sustainability and Power and Carbon Market in National Stock Exchange. Today, we are gathered here to speak about a very important topic, launch of Electricity Monthly Future on NSE, which is going live on 14 July 9 a.m. We'll be talking about this topic, which is quite relevant, and we're also taking some question answer here. With me, my colleague Anil is there from Power Exchange of India Limited.
Good morning, everyone. I am Anil Kale from Power Exchange India Limited. I head the strategy and regulatory team at Power Exchange India.
So we will talk about the launch of NSE Monthly Electricity Future on NSE, which is going live on 14 July 9 a.m. To begin with, I'll be talking about how exactly the electricity market globally are set up, what kind of contract SEBI has approved for NSE to begin with. I'll go specific of the contract in terms of what is the minimum and maximum position size, how exactly different category of customer can use it for their hedging, how exactly we are settling this contract using the PIXL equation. The most important thing is when exactly you can see a kind of trend of pricing and how would you settle on the last day, one day before expiry. In the end, I'll be talking about the global experiences in the same product and how we are also planning to somehow streamline our product launch with the global best practices. And last but not the least, how different participants can come here and hedge their price risk. When I talk about power sector market, we need to understand power sector economics. Every one of you are quite aware about three segments of value chain of power sector. One is generation, transmission and distribution. Now, I'll let you distinguish between transmission and generation. Generation is large plants which are being owned by NTPC, Adani, Reliance, Renew Power, solar plants, wind power plants, thermal power plant. Transmission is high tension wire lines, 440 kV or HVDC lines, which you see when you fly on the aeroplane or you take the trains or you go in the buses. These are the interstate, intercity long transmission lines. Distribution are those lines which you see across your homes or your shops or your commercial offices or your malls. These are basically managed by your local distribution company. But there is a very important segment which is missing in India, which is retail supply segment. So beyond meters, globally, this segment has been unbundled from distribution companies and there is no license requirement. People like you and me can also go and take participation in this, and we can also become retail supplier. These people buy power directly from the market and then sell to their captive customers. In case of India, unfortunately so far this has not happened. Indian distribution companies are owning both the aspect, distribution and retail supply, and many times it creates their own problem. When we talk about electricity markets, electricity futures, it's very important to understand what is the underlying. Underlying here is the electricity commodity. And the very important aspect of electricity commodity is it cannot be stored. Unlike other commodities like gold, silver, crude, these commodities are storable. There is a convenience yield. It has own impact in terms of storage cost, marketing contour or backwardation. In case of electricity, such concepts are not that visible because electricity cannot be stored. It has to be consumed same time. And that brings its own complication. However, a spot market regulator across the globe has tried to brought these externalities out of the system by putting congestion management, imbalance mechanism, or ancillary services regulation separately. I'll not talk about that much today, but you need to understand since it cannot be stored and it moves at the speed of the light, prices has to be settled before the transition happens. It has to be always ex ante. It can never be ex post or it can never be real time. This commodity is very much important to the nation, the people, and for the development of the country. So this public good aspect we always keep in mind when we talk about trading this commodity. And very important thing, last but not the least, at this stage, demand side elasticity is not available. You and me cannot participate. We are captive to our distribution company. Globally, up to 50 kilowatt customers have been allowed to participate in very active and very dynamic and liquid future markets where they can go and buy their own electricity or has their own price risk. In India, that market will begin now when NSE will launch their electricity future by 14 July 2025. I talk about which are the present options available to a generator or distribution company. When there's no future, either they are captive to their distribution companies as a buyer. They can buy through long-term PPA. As an industry, as a large customer, I can go to traders like PTC, for that matter, or GMR Energy or Adani Power, Adani Trading Company, and trade my power for next 3 months or next 11 months. Standardized bilateral contract, we call it customized bilateral contract, because there is no financial future like electricity futures available. And with the launch of electricity future, we are going to sort it out. I'll be briefly reading about the salient feature of monthly electricity future. This future contract is being symbolized as ELAC MBL, electricity monthly base load, is a short form. It is available for 1 plus 3 months, current month plus next 3 months ahead. Though all the months are allowed to be traded, but at this stage you can see the prices for current month and next 3 months. Trading would be starting from 9 a.m. to 11:30 p.m. or 11:55 p.m. based on the US sunlight hours. The minimum unit size, when we say minimum unit size, means minimum lot is 50 megawatt hour, 50,000 units. The tick size is rupees per megawatt hour. Price quote would be rupees per megawatt hour, similar to spot market. To take care of the initial volatility and to take care of the basis risk, SEBI and CRC have jointly decided to put a daily price limit of 6% first to begin with, and then enhanced level of 3%. Cumulative DPL would be 9%. Unlike CRC price cap of 10 to 12 rupees, here the price cap changes every day up to 9%. Initial margin, which has been defined by CRC and SEBI, NSE is quite compliant to that. We have kept our initial margin around 10%. There will be days when there will be additional margin calls, which is high volatility in the real-time prices. In that case, you can get a margin call for 2 to 3% extra, but no case is going to cost you 10 to 15% of the contract size. Keeping in view the sensitivity of this product, keeping in view the public good aspect of this product, CRC and SEBI were quite conscious that the open position should be such, or the position limit should be such, that it does not disturb the spot market. So for the individual client, they have kept a limit of 3 lakh megawatt hour, which is 0.3 billion units or 5% of market wide open positions. And for member clients, they have kept a limit of 30 lakh megawatt hour or 3 BUs or 20% of market wide open positions, whichever is higher. We do believe these position limits are reasonably good in size. We'll talk about those numbers in terms of megawatt also. The daily settlement will happen between 11 to 11:30, like other future contracts. And that price would be a kind of benchmark to settle your mark-to-market settlement. Once in a month, one day before the expiry, we had decided to keep that expiry time 12 p.m. I repeat, 12 p.m. one day before. The prices would be settled on a financial settlement price, or okay, the final settlement price. This price would come from Power Exchange of India Limited, basis the equation defined by the exchange. At this stage, exchange has decided to take volume weighted average of all the 3 exchanges, Power Exchange of India Limited, India Energy Exchange and HPX. This volume weighted average would be basically for each day for all the power segment. When I say power segment, only for day ahead market I am speaking here. Green market, high power market and conventional power. All the DAM segment of the 3 exchanges will be volume weighted average, and that price will become a kind of settlement price and the end. These are all cash settled. There is no physical power delivery or consumption required. Just run through, every customer who has a 70 kilowatt requirement can now come and participate. Even a generator like solar generator who has 350 kilowatt of power setup in their farmhouses or in their factory rooftops or they own some utility scale firm. If they have 350 and above kilowatt of power generation capacity, they can come and hedge and take the minimum order size here. Maximum allowable position, as I read, when we convert this 0.3 billion units or 3 billion units, it happens to be 2 gigawatt for solar, 1.1 gigawatt for wind, for thermal about 500 megawatt, for hydro similar 500 megawatt, for hybrid like with a mix of solar and thermal it could be around 830 megawatt. In case of members, these positions are roughly 3 BUs. So just to give an example, a solar of around 21 gigawatt, you can take the cumulative position. These are open positions. You can take multiple trades, but open position at the end of the day or at the time, anytime, it could not be more than 21 gigawatt at the member level, at aggregate level. For wind, it is 12 gigawatt. For thermal, it is around 5.5 gigawatt. And for hybrid, it is around 8.33 gigawatt.
Friends, as everyone of is aware, CA had come out with the LGBR report for FY 24-25, wherein the gross generation identified for the year was 1900 billion units of electricity. Considering the fact that you have auxiliary consumption and the T&D losses of nearly 21%, what remains is the supply to the consumers, of which nearly 1263 billion units, so that's about 70%, is transmitted under the long-term power purchase agreements, which could vary from 15 years to as high as 40 years. 15 years is typically for gas-based plants, 40 years could be for the hydro-based plants, and anything in between of at least 25 years could be your conventional coal-based plants, hydro, wind or solar-based plants. And then in addition to this, you also have the short-term market, which is about 238 billion units, that is contributed by 3 segments in this market: the power exchanges, the OTC bilateral, which is through the traders, and then you have the demand supply balancing one. The power exchanges today contribute about 144 billion units in 3 different types of contract. One is the day-ahead market, other one is the real-time market, and then you have the term-ahead market, wherein trading up to 90 days ahead or 3 months ahead can be contracted, and this volume is about 144 billion units. On the other hand, the OTC market, which is through traders, contributes to about nearly 90 billion units, and then you have the balancing one, which is about 10 billion units. So net on the short term side, we have 213 billion units, which is likely to be traded in the short term. And when we now look into what is envisaged on the or how the derivatives market would increase and pan out or evolve over a period of time, a cue can be taken from how the international markets have operated in the futures and derivative segment. The matured markets like Europe and Nord Pool commenced way back in 90s. The futures market over there has now stabilized to about 3 times the overall generation in the country. And when it comes to other markets like Australia and Singapore, in the initial stages, the derivatives market was about 5 to 6 times of the total generation. So considering that India had about 1900 billion units of generation in the previous financial year, then we are looking at the sizes to be nearly 3000 billion units, which will be average of the derivatives across the key regions, and then about 8000 billion units, which could be the highest derivative to generation ratio. And when we look at how the derivative markets have impacted the electricity system or the power system in different countries and configuration, what we have identified is in Europe, it has led to stabilizing the wholesale prices. In the US, the markets operated by CME and NYMEX, the volatility, spot volatility has reduced by nearly 50%. And in the Chinese, which is the Shanghai Futures Exchange, the power futures have provided long-term price certainty for generators. So going forward, in the Indian electricity system, when we follow the models of EX and China, it is expected to lead to stabilizing the wholesale prices in the spot market and also giving price signals for future investments. And we look into how the electricity futures price will be based on, primarily it will be based on the demand supply trends that is existing, the availability of power generation. When we say demand supply and availability of power generation, we need to appreciate the fact that you have renewable generation which could be intermittent in nature. You have the conventional, which is primarily the coal-based plants, wherein supply of fuel and availability of fuel plays a role regarding how the generation happens. Then you also need to factor in the seasonal factors and weather variations that could also affect. As everyone is aware, during a calendar year or during the financial year, you have different seasons across different months, and the consumption varies across season to season, and there could also be variation in demand due to weather fluctuations that happen. So all these need to be factored in when we are entering into the futures market. And also there could be other market demand forces which could be socio-politically. Generally it is observed that whenever states approach the elections in their states, it may lead to increase in prices, and this phenomenon is observed across all over the. So all these factors need to be considered when we are looking into the futures market. And when we look into how the contracts are structured in other markets, primary Q can be taken in from two different types of market. One is the Nordic market, where you have both the baseload contracts and you also have the peak seasonal contracts. And then we can also look into the larger EX market, wherein different types of contracts were introduced, or different tenures of contracts were introduced. They now have multiple tenure contract. The yearly contract has the maximum traction, wherein nearly 70% of the contract gets traded on the yearly basis. Then you have the quarterly contract, you also have the monthly contracts, and they also have weekly or day ahead futures contract. Going forward, looking at the transaction from the international queue and the approvals that have been received post introduction of the monthly contracts, as traction in monthly contract increases, NSE would be introducing quarterly contracts, where window up to 7 quarters ahead is what we are looking at. You may also have the annual contracts, and then in addition to this calendar tenure contract, we will have an immediate market in the form of CFDs that will be introduced shortly. And when we look at in addition to calendar contracts or in addition to the base load contract, are there any other contracts? Yes, a Q can be taken in from Nord Pool, wherein they also have peak contracts, and these peak contracts are typically for peak hours of the day, and wherein settlement could be on weekly basis. They also have forwards of peaks for monthly, quarterly and yearly. So considering this factor and the potential that we have in the Indian electricity system, we expect the futures market to reach the traded volumes of nearly $175 billion to $475 billion. And when we look at how the trading screen will look like on the futures platform, yes, the platform would be exhibiting the DDR values for the previous months. It will also be exhibiting the bid ask or the bid offer prices received from different participants, and it will also display what is the futures contract which is for the next 3 months. So currently, like since we are in July, you will always have futures contract pricing for August, September and October that is being traded. Net, when we look at how the electricity market system is expected to evolve after introduction of monthly futures contract, we see that all the stakeholders, so whether they are generators, whether they are discoms, whether they are large industrial consumers or the trading entities, the futures contract is a hedging mechanism for everyone to lock in their prices. And when it comes to generators, it will ensure stable cash flows and provide financial risk. On the other hand, when it comes to discoms and industrial consumers, they'll be able to plan their contracts or plan their power procurement effectively and improve their financial stability. In addition to this, for the traders and financial institutions, we see this to be a new market segment in terms of energy trading or electricity trading desk being institutionalized for all the institutional investors. The price hedging mechanism will be a major instrument to drive future investments in the electricity system, in the power sector, and it will also provide a hedged market for increasing the foreign investments and market participation. In addition to all these stakeholders, we also expect good amount of retail participation from hotels, malls, corporates, ultra high net worth individuals who will become natural hedgers in this derivative market.
We need to appreciate that electricity, which is a basic requirement for us, and I say all of us, like we consume roti, kapra, makan, electricity or Wi-Fi have also become very essential part of our lifestyle. And when we see the numbers in terms of how exactly electricity sector will grow, these are very good numbers. Per capita electricity consumption of India is around 1300 units per capita. When we compare it with the global averages, global average around 2800 to 3000 units. So we are virtually 50% of the global average. If we see China is consuming around 4000 units per capita. So we are also almost one third of China. Europe is consuming around 36,000 units. Again, we are almost 120 times less than Europe. America is consuming around 24,000 units. So if you see in terms of electricity consumption, we are going to grow very big. The numbers are encouraging in terms of the CAGR. When we see the number from here to 2030, from 1300 units to 2030 will be touching around 2000 units. Still less than the global average, but I think year-on-year growth will be around 10%. In terms of our energy generation, which is now touching around 1900 BUs, it will go to roughly 3000 BUs in next 3 to 4 years, again 10% CAGR. So if you see the GDP growth is at 6.5%, whereas electricity consumption will go by 10% year-on-year. I do believe that electricity future market will be instrumental in terms of meeting this extra power consumption by individuals, by factories, by ultra HNIs, corporates, because a lot of investment seeing the long-term pricing signal emanating from futures will be attracted. This investment will go to additional power capacity in terms of battery storage or pump hydro storage or offshore wind or solar or wind for that matter. But the long-term pricing signal, as we were talking about, that we are so very soon we are going to launch annual future contract. This future contract will give a lot of visibility on the prices, and those prices will attract a lot of investments. In terms of present consumption pattern, roughly 68% power in the entire power basket has been consumed by residential industrial customer, and I think this too will drive the energy consumption requirement, especially in electricity. The other sector like agriculture, allied activities are consuming 32%. So industrial residential customer, including commercial customer, would be the key driving force when they will drive this growth. Having said so, our transport sector, which is presently depending upon the crude oil or petrol or diesel, will also move from fossil fuel to electric vehicle, primarily driven by the electricity, or we say the grid electricity. This will also need to a lot of power consumption requirement. So overall, in brief, what I would like to say, that though at present spot market volumes are very low, the volatility in the spot market volume is ranging from 16 to 20%. This volatility is reason because the power market, especially spot market volumes, are very low, 6 to 7%. As the consumption will grow, as the more and more hedging instrument will come, more and more power will transfer from long-term PPAs to short-term market, this volatility also go down. My understanding of the market way forward is when the future market will come in terms of multiple products like monthly future contract, quarterly future contract, or for that matter, annual future contract, along with the CFD layer, a lot of long-term volume PPA will go to short-term market. Future will become a very important platform for industries, residential customer, commercial customer, and retailers to come and hedge their price risk. The prices, which now showing a lot of volatility, will go down because now there is a counter product which will hedge the price risk or reduce the volatility. In a nutshell, the launch of electricity future is going to be transformational in terms of power sector reform and attracting more capacity. NSE is committed to make this product a success because this product is going to play a very instrumental role in promoting the growth of electricity market in the country. Our mission, our vision is around one grid, one nation, one price. We do believe electricity future will lead to market coupling, also participation of retail customer in the long term to come.
What is an electricity future?
Electricity future a contract where participants can lock in the price of electricity today for a specified future month ahead. No physical power is delivered.
Okay. Who can participate in electricity futures trading?
Any eligible trading member, corporate buyers, generator, retailer, or financial institution approved by SEBI can very well participate.
Can retail investors participate?
Yes, retail participant can invest via their broker, subject to exchange norms and risk disclosures.
Is there physical delivery of electricity in these contracts?
No, these are cash settled contract. There is no physical delivery required. However, please take due risks, due chances in terms of reading all the materials before taking any position here.
What index is used for settlement?
So to begin with, we are using the Power Exchange of India Limited equation, which is taking volume weighted average of all the day-ahead markets in terms of power being traded there. When we taking the power, we are taking the green day-ahead market power, we are taking conventional day-ahead power market, we are taking high price power also.
How does a buyer benefit if the contract is cash settled?
So if buyer is taking a long position and if the future prices goes beyond the price which had the strike at, he makes cash and he makes gains. If the prices goes down against this strike price, then he make losses, and in that case he bear the losses. Both are cash settled. There is no need to give any electricity supply in physical market.
What happens after I buy a futures contract? Does my supplier reduce my bill?
No. Electricity future contracts are being traded on NSE, where your utility bill is being served you by your utilities. Both are very different things. Your profit and loss of exchange is settled in cash, where utility bill you take the electricity and give price in cash. So both are very different.
Who handles clearing and settlement?
NSE Clearing Limited, which is a QCCP rated entity, handles all settlement and margining.
How do I estimate a fair price of electricity when it differs city to city?
So the index which we are taking here, NLG, is very much national in nature. Not only we are taking one exchange price, we are taking all the three exchange volume weighted average. And this index is kind of national in nature, taking care of interactions, dispatches happening across India. So it doesn't affect city to city. It's a national average and settled accordingly.
What are the extra charges beyond price like transmission, cross subsidy, etc.?
As such, similar to spot market, there are no charges here. It's very, very different here. In a derivative market, we only charge CTT, which is Commodity Transaction Tax, and some VAT. NSE is promoting this product because it's a very new product and it's a very transformative product for power sector reforms. So for 6 months, NSE is promoting this product by charging zero transaction charges. There is no cross subsidy, open access, or additional surcharge being charged by NSE. We don't charge on any other commodity also the same.
Can this help industrial buyers control costs?
Yes, buyer in advance can hedge their price risk by locking their prices in advance.
What are the typical use cases of electricity futures in India?
To begin with, when it is confined to ultra HNI, corporates, industry, SMEs, Discom and generator, I think some of the use cases could be Discom can lock their peak season rates, generator can secure their merchant revenues, industries can fix their input power prices, and most important, even traders, which are a very important part of this integrated market, can take some position being a hedger or as a speculator or many times an arbitrager also.
How do we track electricity demand or supply trends to decide trades?
So at this stage, spot market is quite liquid, and we can go to the sites of all the power exchanges India Limited because every 15 minutes they are putting their prices in the day ahead market. In the end of the day, almost at 4 p.m., they're also putting their prices. You can also track POSOCO, CA, NLDC, and other power exchange data to keep abreast with the latest price trends.
Is any real-time data made public by NSE?
Yes, NSE commodity segment. When we'll make this product live, you can see the spot DAM price. You can see the real-time price, which is being updated every half an hour for our participants. At the same time, we'll show the what kind of volumes we have done, what is the open interest. At the most important thing, we'll also show the number of lots in numbers and number of lots in volume, which is megawatt hour. Most important, we'll also show the volatility increasing or decreasing every hour.
What is the duration of the contract?
Duration of contract is only 1 month to begin with, but NSE has plans to launch multiple products. I'll talk about that later.
Can electricity prices be benchmarked with global trades?
Not exactly, because we are taking at this stage the volume weighted average price of our own exchange, which is our own domestic market. And India is a very liquid spot market. Almost 12 to 14% power being traded, be it in spot, be it in DAM, RTM or OTC bilateral. I think those prices are emanating from our own country. It shows my consumption demand. It shows my generation pattern. I think we need not to see any global indices right now.
Are there similar products in China, Europe or any other international markets?
Yes, electricity future or electricity derivative market is a very mature market in some of the countries like in North Pole, Norway. It's operating since mid of the 90s, 1994. In UK, it got started in 1999. In US, it started in 2000. In Australia, it started in 2006-8. And in Singapore and recent few editions in 2015 onwards. So I think it's a very, very liquid contract, very liquid market across few developed countries.
Will generators and discoms only lead pricing or participate too?
Both. I think being the anchor large generators or being the anchor large buyers, their volumes would be very high. So it would definitely affect the prices when they take liquid positions. However, they can also follow the trend. The good part of this liquid electricity market is everyone is going to be a price taker, not a price maker.
Is this market significant for small participants?
Not in the beginning, but as the time will pass, as more and more contracts will be launched, and the liquidity increases when the prices get stabilized, I do believe retail will also participate, and it signify their trading volumes also.
How will contract for differences fit into this later?
Contract for difference is a very good method to divert the long-term PPA volume to short-term market. And secondly, of late, it is being used for some developed countries like UK, like Australia, to attract the renewable generation capacity. We do believe that a CFD in India, when we launched, which NSE has plans to do, it will do both. It will not only attract the long-term investment in renewable, but at the same time, it will transfer the long-term PPA volume to short-term PPA volume.
What if my futures contract is loss-making?
See, it is cash settled. And when you enter into future, we do believe that you have done your own research. You have a take on the price. If the price goes against you, you book the losses, pay cash. There is no as such compulsion of taking or keeping the delivery with you. It's a cash settle. Sometimes you will gain, sometimes loss. But again, I said, do your own due diligence, do a lot of research before taking any position here.
What is the role of power exchanges in this market?
Power exchanges are the de facto spot exchange. They are giving us the base prices in terms of settlement, day-to-day basis, RTM basis, and for monthly settlement. And they're also giving the actual signals. The important thing is, future is nothing but a hedging instrument. All these spot market power players ultimately look towards the financial future market for hedging the prices. Spot and future work in a virtuous cycle, Without spot, a future cannot be there, and without future, spot cannot hedging tool. I think this is a good time for India. At this, we have both the markets now.
Can we hedge long-term power through this short tenure products?
Yes and no. Yes, in a sense, for 1 plus 3 months, you have this contract. So you can foresee the 4 months contract, 4 months prices. But when you say long-term, in Indian parlance, long-term means above 1 year. NSE has plans to launch quarterly 1 plus 7 quarter ahead. And NSE has plans to launch annual contract 1 plus 5 years ahead. I think once those contracts will be coming, the hedging or the price signaling for long-term contract will be better. At this stage, you can roll it month on month, but these are, I'll say, short-term price certainty or price hedging happening right now.
Where can I learn more about the contract or try mock trading?
NSE, while launching its contract, is giving a lot of information in its website. We have a dedicated page on our website giving you information around many aspects of spot trading, be it power generation volumes, transmission corridor, weather patterns, or any other incident happening which is affecting the generation of transmission. Having said so, NSE would keep doing the webinars like we are doing today. We'll be doing a lot of workshop, physical. We'll be meeting a lot of industrial and commercial and residential customer too, to teach them about this. You can join those workshops, or you can join any of the webinar by purely registering with our webinars.
How does transaction in power exchanges differ from transaction in electricity futures?
Very brief, I'll answer. In the spot power market, you are actually physically trading in electricity. Having said so, only few players like large generators, large discoms, large traders, and heavy industry customer like 1 megawatt above customer can participate. So there are a lot of restriction in terms of participating in the power spot exchanges. In terms of future market, there's no such restriction. Any retail buyer through their broker with proper risk analysis of their profile, proper studies, can participate. There's no bar. So in the spot, you deal in physical. In the future, you deal in cash. So there are restrictions in the spot market. There are no restriction, but here you have to be very informed, because trading in the future option many times quite risky.
What is the mix of participants in power exchange and in the futures exchange?
As I said, this interaction between power exchanges, which is spot exchange, and NSE Electricity Future, which is the direct derivative exchange, is going to be very virtuous. All the participants which are presently going to the spot market, like generator, discom, trader, big industries, SMEs, corporates, resort, hotels, malls, whichever are now in the spot market, has to come to financial future market for hedging their risk. So I think the similar level of participant would come, but I'm seeing an interesting class which will also come. Some arbitrage, which could be a prop trading desk, some algo trading companies which are taking a lot of interest and they're running global desk, Some big FPIs will also be coming here in terms of taking the position and giving a direction to the market.
Whether a member or a client of PXIL needs to register with NSE for trading in futures?
Yes, for sure, because at this stage when member and clients are being trading on PXL, they are working under PMR regulation of CRC. Here, electricity future under the purview of SEBI. So any member who is on a spot power market and now going to PXL, if they like to register with NSE, they need to come and register separately as per the SEBI norms.
Whether the clearing and settlement of electricity delivery and in electricity futures would be done by the same entity?
No. Electricity derivative is a different settlement mechanism. Here NCL is doing this settlement clearing, whereas in case of the physical delivery, the Power Exchange India Limited through the clearing members are settling. So both are very different mechanism.
Whether there is a difference between settlement period of physical trading in PXIL platform and that in electricity futures trading?
At this stage, for electricity future, we launch only monthly contract. So we'll be settling once in a month, one day before the expiry. Whereas in case of Power Exchange of India Limited, there are day-ahead market product, there are term ahead market product, there are 3 months ahead market product. Their settling is quite different from what we are doing it here. At this stage, we are offered just 1 month contract with the settlement happen once in a month, one day before the expiry. MTM on day-to-day basis would be separately happening.
Whether lot size remains same between Power Exchange India Limited and the electricity futures contract?
So Power Exchange of India Limited, as there's no such restriction on the lot size because it's a very different market governed by CRC. Here in case of SEBI, there are certain minimum maximum order size and there are some position limits. To begin with, SEBI has prescribed a minimum order size of 50 megawatt hour, which is 50,000 units. And the maximum order size is 50 times of 50 megawatt hour, which is 2500 megawatt hour. In case of PIXL, as there are no limits. Thank you very much all the participants for giving us the opportunity to share our perspective on the upcoming electricity future market on NSE and sharing our thoughts how electricity market will become a very big market, how hedging instrument like futures CFDs will give you a new tool to hedge your price risk. My sincere appreciation for participation of all of you, and especially Anilji. Thank you very much, Anilji, for coming and interacting with me. Thank you very much. I really appreciate it.
Thanks.